morning, Trinidad and Tobago, and welcome to the Bourse Report. And of course, Happy New Year to all of the viewers of CNC3 and the Bourse Report. Well, it was quite a challenging and eventful year. I guess one of the most often used words was unprecedented. And ultimately, that's what was reflected in financial markets across the globe and at home. Now, at the end of 2020, it was quite a positive year for international markets. For local markets, not that much. Let's take a look today at what was in 2020, and next week we'll take a look at what could be in the year ahead. So turning quickly to our local market and the equity market drivers for the 2020 period or the 2020 year. Well, no surprises there. The COVID-19 pandemic was one of the major driving forces for equity markets at the local and regional level. The energy market collapse, which was part and parcel of that COVID-19 pandemic, also played quite a significant role on investor sentiment and indeed a lot of lower economic activity in the Trinidad and Tobago landscape. And that would have overall led to weaker investor sentiment, which would have been reflected to some degree in stock market prices at the local level, as well as the cross-listed level, which was actually more pronounced, which was somewhat surprising. So when we take a look at the performance over the course of 2020, we can see that the Trinidad and Tobago Composite Index, which takes a look at all of the stocks listed on the local stock exchange, was down just around 10% after falling as much as around 16% earlier at the peak of the pandemic in terms of investor uncertainty. The All Trinidad and Tobago Index, which includes all of the locally domiciled stocks, actually didn't fare that badly, all things considered, and was down just around 5.2% after falling as much as 11 to 12% again around that peak uncertainty period. Now, the cross-listed stocks, which include stocks like NCBFG, JMMB, First Caribbean International, and Grace Kennedy, did close the year down around 18.4%, and they never really recovered, or those cross-listed stocks never really recovered from the peak pandemic uncertainty, which would have taken place earlier in the year when the coronavirus or COVID-19 would have really sparked investor concerns across the globe. Now, when we take a look at some of the major movers on the Trinidad and Tobago Composite Index for 2020, we can see that there are some surprising names which would have done exceptionally well in the year that has now gone. NFM, or National Flour Mills, would have appreciated some 55%, and that would have been on account of more persons baking at home, more persons making their roti, their bread at home, and that would have definitely helped out NFM as well as their cost containment strategies. Trinidad Cement Limited was somewhat surprising in terms of their 25% increase over the course of the year. One would have imagined that with slower or lower economic activity, there would have been reduced construction demand and demand for construction materials. However, the TCL was broadly resilient, although they did suffer some declines or hits to their revenue. But the investors seem to be quite bullish on TCL's prospects in the year gone by and also in the year ahead. Answer Merchant Bank also advanced just around 11.5%, and that was on account of its relatively stable operations, notwithstanding a reduction in earnings. But that Bank of Baroda acquisition, which has been confirmed and is pending regulatory approval, would certainly be quite a positive development for Answer Merchant Bank. Massey was also up 6.6%, and Republic Financial Holdings up 2.9% in what could be described as a challenging year for most banks, inclusive of Republic Financial Holdings. On the other side of things, Unilever, NGL, unsurprisingly, with the energy market collapse, was down 29%. Guardian Media and National Enterprises Limited were also more significant underperformers, as well as One Caribbean Media, down between 40 and 50% respectively. And that continues, but there should be some recovery in the months ahead, one would imagine. At the international level, it was a much different story. Yes, the COVID-19 pandemic did affect investor sentiment. And yes, there was an energy market collapse, but that really would have been restricted to one particular sector when we take a look at the US market sector performance shortly. However, extraordinary monetary and fiscal stimulus would have certainly restored investor confidence and possibly led to one of the stronger bull markets we would have seen in previous years. And that would have been reflected across the globe, not just in the US, in terms of fairly strong equity market performance. If you look at the 2020 performance in that purple column, we can see that the US advanced just around 15.5 to 15.6%, which is quite exceptional after being down around 32% as at the end of April or thereabouts. European stocks advanced 4%, which would have capped quite a strong performance on the heels of 2019, where they would have advanced just around 20%. Asian markets also rallied quite significantly, despite being the epicenter of the coronavirus outbreak. And we see that they would have advanced just around 19.8% to cap another very strong 15.8% performance in 2019. Latin America was the one major regional laggard, which was down 15.5%, again, being fairly commodity-oriented or exposed to commodity price performance. They would have declined just around 15.5% compared to that 13.8% increase experienced in 2019. When we take a look at U.S. market performance over the course of the year, some surprising, some not surprising sector performance. Overall, as mentioned, S&P was up around 16%. Energy, on the one hand, which was understandable, was down just around 36%, where the energy sector stocks were down around 36%. Financials down just around 5%, so are relatively resilient, notwithstanding the conditions. Utilities and real estate down 4% and 7%. On the other side of things, technology and communication services, that would be your Facebook, your Amazons, etc., would have been up 42% and 25%, and we would have all observed, for those who follow the US markets closely, the very significant run-up in stocks such as Zoom, which would have certainly been beneficial and is being beneficial right now, as we can see, for the continuation of business as somewhat usual under pandemic conditions. So what's in store at the local and international levels in the year ahead? Well, next week, we're going to take a look at some of those key drivers and what investors may expect and how they might want to position their portfolios for those of us who do like to dabble in stocks. Well, that's it for this week's edition. For more information, give us a call at 226-8773 or 2Bourse. Email us at invest@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, for all of our research, which is absolutely free. And you can catch us in today's business section of the Bigger, Better Trinidad Guardian. Have yourselves a wonderful investing week. This has been the Bourse Report.